What if one of the biggest forces shaping your mortgage rate, your stock portfolio, and the entire U.S. economy isn't in Washington at all? Not the latest Fed meeting, not the AI boom, not even the loud political drama everyone argues about online. What if the real story starts in Japan with government bonds? I know, that sounds painfully boring, but that's exactly why it matters. The biggest financial shifts usually don't arrive with fireworks. They show up quietly in places most people never think to look, and by the time everyone notices, the impact is already spreading. So if you've been wondering why mortgage rates stay stubbornly high, why markets feel jumpy, and why rate cuts don't seem to magically make money cheaper, this might be the missing piece. Most people assume the Federal Reserve controls all interest rates. That sounds reasonable. The Fed cuts rates, borrowing should get cheaper, right? But that's only part of the story. The Fed has the strongest influence over short-term rates, the front end of the system. But many of the rates that affect everyday life, like mortgage rates and long-term borrowing costs, depend heavily on long-term bond yields. And those are shaped by something much more basic: supply and demand. That's where Japan enters the picture. For decades, Japan played a quiet but extremely important role in global markets. It became one of the most consistent buyers of foreign assets, especially U.S. debt. That steady demand helped keep long-term yields lower than they otherwise might have been, and now that support may be getting weaker. To understand why, we have to go back to the early 1990s. Japan had a massive asset bubble. Real estate surged. Stocks surged. Then, the bubble burst. After that, Japan entered a long period of weak growth, low inflation, and stagnant wages. It was like the economy got stuck in slow motion. So the Bank of Japan did what central banks often do in a weak economy. It pushed interest rates down. Eventually, rates were near zero for years. Later, Japan also used something called yield curve control. Ignore the intimidating name. It basically meant the central bank tried to keep long-term government bond yields very low, even if markets wanted them higher. Now think about what that means for a Japanese pension fund, insurance company, or bank. If safe bonds at home pay almost nothing, what do? You can accept tiny returns, or you can look overseas for better opportunities. So for years, a lot of Japanese capital flowed abroad. A simple way to think about it is this. Imagine an investor who can access very low-cost funding in yen. If they can then invest in assets elsewhere with higher yields, the difference can look attractive. That broad dynamic helped push huge amounts of money into foreign bonds and other assets. This is often described through the idea of the yen carry trade. And here's the important part. When money is very cheap in one place, investors naturally go searching for better returns somewhere else. That matters because these flows didn't just affect one corner of finance. They touched U.S. treasuries, mortgage markets, stocks, corporate borrowing, and more. For a long time, global markets benefited from that river of low-cost capital. It was like the world got used to an extra source of financial oxygen. But systems built on the idea of cheap forever are fragile. And in 2024, that assumption started to change. Japan began moving away from the ultra-low-rate world investors had become used to. As Japanese yields rose, money no longer looked as cheap as it once did. Suddenly, investors had more reason to keep capital at home or rethink where they put it abroad. That shift may sound technical, but the effect is very human. When the math changes, behavior changes. People become less aggressive, less willing to stretch for returns, less willing to buy assets simply because money used to be cheap. And when enough big institutions think that way at the same time, markets feel it. Here's the deeper truth. Markets are not just driven by headlines. They're driven by incentives. And incentives change when the cost of money changes. For years, the U.S. benefited from strong foreign demand for its debt, including demand linked to Japanese institutions and investors. That mattered because when there are plenty of steady buyers for long-term treasuries, yields can stay lower. But if one major source of demand becomes less reliable, yields may need to rise to attract other buyers. And that changes everything. Because the 10-year treasury yield is not just a random finance number on a screen. It acts like a reference point for the entire system. If long-term yields stay high, mortgage rates tend to stay high. Stock valuations come under pressure. Companies face higher borrowing costs. Financial conditions stay tight, even if the Fed cuts short-term rates. This is where many people get confused. They think, if the Fed cuts rates, shouldn't everything get easier? Not necessarily. That's because long-term rates can remain elevated if markets demand higher returns to absorb all the debt being issued. And the U.S. issues a lot of debt. So if demand softens even a little, it matters. A good analogy is this. Imagine the Fed controls the faucet in your kitchen. Important, real, and powerful. But long-term yields are more like the water pressure for the whole building. If the pressure is off, changing one faucet doesn't fix everything. That's why markets can feel strange in times like this. Headlines may say rate cuts are coming, but ordinary people still see expensive mortgages, expensive loans, and expensive capital. And that disconnect creates frustration. Psychologically, people want simple cause and effect. The Fed cuts, life gets cheaper. Clean story. Easy story. But finance is usually more like a chain reaction. One country changes policy, capital flows shift, bond demand changes, yields move. Then housing, stocks, and business activity respond. The final result shows up in your life long after the original cause. Think of it like dropping a stone in a pond. The splash happens immediately, but the ripples take time to reach the shore. And sometimes, those ripples collide with waves coming from other directions, other central banks, other economies, other policy decisions. The water at the edge where you're standing might look nothing like what you expected from that first splash. So what should you actually take away from all this? First, don't assume one headline explains the whole economy. If the Fed cuts rates but long-term yields stay high, borrowing may still feel expensive. That's why mortgage relief may not arrive as quickly as people hope. The housing market, in particular, responds more to long-term rates than to what the Fed does with short-term rates. A first-time homebuyer isn't getting a loan based on the overnight rate. They're getting a 30-year mortgage tied to those longer-term bond yields. Second, pay attention to the bond market, even if it seems boring. Stocks get the attention, but bonds often set the foundation. When bond yields rise, it affects everything from corporate expansion plans to government spending capacity to how attractive stocks look compared to safer investments. The bond market is where the real price of money gets determined, day after day, transaction after transaction. Third, understand that global finance is deeply connected. A policy shift in Japan can affect U.S. housing, corporate borrowing, and investor sentiment much more than most people realize. Money doesn't respect borders. It flows to wherever it can get the best combination of return and safety. When conditions change in Tokyo, capital that was buying U.S. assets might suddenly shift direction. When Europe adjusts its policies, it changes the calculus for investors everywhere. And finally, be careful with simplistic narratives. Not every market move is about one politician, one Fed speech, or one trending topic. Sometimes the real driver is a slow structural shift happening quietly in the background. For everyday investors, that means staying patient, staying diversified, and avoiding emotional decisions based on noisy headlines. The goal isn't panic. The goal is understanding. Because when you understand what's happening beneath the surface, you make calmer decisions above it. You stop reacting to every headline and start recognizing the difference between noise and signal. You begin to see patterns instead of just random chaos. The biggest risks in finance are often the ones that feel too boring to matter. A bond market shift in Japan doesn't sound dramatic. It doesn't trend like AI. It doesn't dominate political debates. It doesn't come with flashy headlines. But it may help explain why money still feels tight, why housing remains difficult for so many people, and why markets keep acting nervous even when the news seems calm. These quiet shifts are like tectonic plates moving beneath the surface. You don't feel them every day, but over time, they reshape the entire landscape. They determine where the mountains and valleys are in the financial world, where opportunity exists, and where danger lurks. That's the lesson. The economy isn't just moved by the loudest story. It's often moved by the quiet plumbing underneath it. And when that plumbing changes, everything built on top of it starts to move too. The pipes might be underground, invisible to most people going about their daily lives, but they're what actually delivers the water. They're what makes the whole system work or not work. Understanding this doesn't mean you need to become an economist or spend hours analyzing bond charts. It just means recognizing that simple explanations are often incomplete explanations, because there will always be changes you didn't see coming.